For decades, the United States has grappled with a persistent trade deficit. This issue has been a focal point of economic discussions and policy debates, influencing the nation's economic strategies and international relations. This means we buy more goods and services from other countries than they buy from us. The shelves of our stores are filled with products made overseas, from electronics to clothing, highlighting our dependence on foreign manufacturing. The Trump administration has made tackling this trade deficit a cornerstone of its economic policy. By focusing on renegotiating trade deals and imposing tariffs, the administration aims to level the playing field for American businesses. The president argues that reducing the deficit will boost American manufacturing, create jobs, and strengthen the economy. He envisions a resurgence of American industry, where factories hum with activity and workers thrive. But his approach, heavily reliant on tariffs, has ignited a global trade war with far-reaching consequences for investors. Tariffs have led to retaliatory measures from other countries, creating a complex web of economic tensions. This essay will delve into the complexities of the trade deficit, examining its causes and consequences. We will explore how historical trade policies, global economic shifts, and domestic consumption patterns have contributed to this persistent issue. We will analyze the potential impact of Trump's trade policies on various sectors of the economy and the investment landscape. From the automotive industry to technology and agriculture, each sector faces unique challenges and opportunities in this new trade environment. Understanding these dynamics is crucial for investors seeking to navigate the turbulent waters of today's globalized economy. By gaining insights into the interplay between trade policies and market reactions, investors can make more informed decisions and better manage risks. The history of trade deficits in the United States is a long and complex one, marked by various policy shifts and economic strategies. From the post-World War II era to the present day, each administration has grappled with the challenges of balancing trade. Trade agreements and international partnerships have played a significant role in shaping the trade landscape. These agreements aim to foster cooperation and mutual benefit, but they also come with their own set of challenges and controversies. As we move forward, it is essential to consider the broader implications of trade policies. Beyond the immediate economic impacts, these policies influence geopolitical relations, labor markets, and technological advancements. The interconnectedness of today's global economy means that changes in one area can ripple across the world. A tariff on steel, for example, can affect everything from car manufacturing to construction and even agriculture. Education and public awareness are crucial in understanding and addressing the trade deficit. By fostering a deeper understanding of economic principles and trade dynamics, we can better equip future generations to navigate these challenges. Ultimately, the goal is to create a balanced and sustainable economic future. This requires collaboration between policymakers, businesses, and communities to develop strategies that promote fair trade, economic growth, and social well-being. As we explore the intricacies of the trade deficit and its impact on our nation, we must remain committed to finding solutions that benefit all Americans. By working together, we can build a more resilient and prosperous economy for generations to come. Imagine a household that spends more money than it earns each month. This scenario is quite common and can lead to financial stress and debt accumulation. The family might have to borrow money to cover their expenses, leading to a cycle of borrowing and repayment that can be difficult to break. They might cut back on non-essential spending, look for additional sources of income, or even dip into their savings to make ends meet. This situation is known as running a budget deficit, where the outflow of money exceeds the inflow. This household is running a budget deficit. Over time, if not addressed, this deficit can lead to significant financial problems, including mounting debt and potential insolvency. The family might have to make tough decisions, such as selling assets or taking on additional jobs, to manage their finances. They may also seek financial advice to create a more sustainable budget plan. Similarly, when a country imports more goods and services than it exports, it runs a trade deficit. This means the country is buying more from other countries than it is selling to them. Just like a household budget deficit, a trade deficit can have significant economic implications. It can affect the country's currency value, its economic growth, and its relationships with trading partners. The United States has had a trade deficit for over 4 decades. This long-standing deficit has been a topic of much debate among economists, policymakers, and the public. Some argue that it reflects the strength of the U.S. economy and its ability to attract foreign investment, while others believe it indicates underlying economic weaknesses and a loss of competitiveness in global markets. This means we have been sending more dollars abroad to purchase foreign goods than we receive from selling our own goods. The dollars sent abroad often come back in the form of investments in U.S. assets such as stocks, bonds, and real estate. This flow of money can help finance the trade deficit, but it also means that the U.S. is increasingly reliant on foreign capital. Several factors contribute to this imbalance. These include differences in savings and investment rates between countries, trade policies, and the relative competitiveness of different industries. For example, countries with high savings rates may have trade surpluses, while those with low savings rates may have trade deficits. These include the strength of the U.S. dollar, which makes our exports more expensive for foreign buyers. A strong dollar can be beneficial for American consumers, as it makes imported goods cheaper. However, it can also hurt American exporters, who find it harder to compete in global markets. Another factor is the high consumption rate of American consumers, who have a strong appetite for imported goods. This high demand for foreign products contributes to the trade deficit. American consumers often prefer imported goods due to their variety, quality, or lower prices compared to domestic products. Understanding the historical context of the U.S. trade deficit is essential for comprehending its current implications. Over the years, various factors such as changes in global trade policies, technological advancements, and shifts in consumer preferences have influenced the trade deficit. By studying these historical trends, we can gain insights into the challenges and opportunities that lie ahead for the U.S. economy. This knowledge can help policymakers make informed decisions to address the trade deficit and promote sustainable economic growth. The impact of trade deficits on the economy is a subject of ongoing debate. Some economists argue that trade deficits can have positive effects. For instance, they can lead to lower prices for consumers who benefit from access to cheaper imported goods. Additionally, trade deficits can foster competition, forcing domestic companies to become more efficient and innovative. However, trade deficits also carry potential drawbacks. A large and persistent deficit can lead to job losses in domestic industries facing competition from cheaper imports. This can contribute to wage stagnation and economic inequality. The debate over the trade deficit highlights the complex interplay between global trade, domestic employment, and economic growth. Section 4. Trump's tariff offensive, a high-stakes gamble. President Trump has taken an aggressive stance on trade, arguing that past administrations have allowed other countries to take advantage of the United States. He believes that the U.S. has been on the losing end of trade deals for far too long, and his administration is determined to change that narrative. By imposing tariffs, Trump aims to level the playing field and bring back jobs to American soil. His administration has imposed tariffs on hundreds of billions of dollars worth of goods imported from China, the European Union, and other trading partners. These tariffs are part of a broader strategy to renegotiate trade agreements and ensure that they are more favorable to the United States. The tariffs target a wide range of products, from electronics and machinery to clothing and agricultural goods. These tariffs are essentially taxes on imported goods, making them more expensive for American consumers and businesses. When the cost of imported goods rises, it can lead to higher prices for everyday items, from groceries to electronics. This price increase can affect the purchasing power of American families and the bottom line of businesses that rely on imported materials. The stated goal of these tariffs is to protect American jobs and industries from unfair competition. By making foreign goods more expensive, the administration hopes to encourage consumers to buy American-made products. This, in turn, could boost domestic manufacturing and create jobs in industries that have been struggling to compete with cheaper imports. The Trump administration hopes that by making foreign goods more expensive, American consumers and businesses will switch to buying American-made products. This shift could lead to a resurgence in American manufacturing and a stronger economy. The administration envisions a future where "Made in America" is once again a mark of quality and pride. However, this strategy carries significant risks. The global economy is interconnected, and tariffs can have unintended consequences. For instance, other countries may retaliate by imposing their own tariffs on American goods, leading to a trade war. This could hurt American exporters and lead to job losses in industries that rely on international markets. Tariffs can lead to higher prices for consumers, reduce corporate profits, and disrupt global supply chains. Businesses that rely on imported materials may face higher costs, which can lead to reduced profits and even layoffs. Additionally, supply chain disruptions can result in shortages of certain products, further driving up prices and causing inconvenience for consumers. The long-term impact of these tariffs remains uncertain, and only time will tell whether this high-stakes gamble will pay off. Section 5. Market jitters. Uncertainty grips investors. The imposition of tariffs and the threat of a full-blown trade war have injected a significant degree of uncertainty into the global economy. Financial markets, which thrive on stability and predictability, have reacted with volatility. Stock markets have experienced significant swings as investors try to assess the potential impact of trade tensions on corporate profits and economic growth. The uncertainty surrounding trade policy has made it challenging for businesses to make long-term investment decisions. Companies are hesitant to commit to major projects or expansion plans when the rules of the game are constantly changing. This uncertainty can have a chilling effect on economic activity, slowing down investment and job creation.